Oh, here we go. We're ready and getting started. Hello, guys. Sorry about that. I'm playing with things I shouldn't be playing with, including turning off our music. There we go. That started a little quicker than I thought. Okay, welcome to our Ask Us Anything tonight, guys. We actually have a few prepared questions that have been asked within our Fearless group here over the last month or so. And so we're going to hit some of those. But of course, the whole purpose of this is for us to answer these questions live with you right now, for those of you that are here with us live. So if you have any questions that have anything to do with real estate investment, property analysis, whatever it might be, property management, feel free to throw those questions in the chat. That's what today is for, is you have the opportunity, if something is holding you back, maybe you're hitting a roadblock, you're not moving forward like you'd like to be when it comes to real estate investment, or maybe you have fear about something in the market, throw those questions in the chat and we will try to address them. And of course, as a group, for those of you, if you have answers to some of these questions tonight that we're going to go through as well, then feel free to share your thoughts on that as well. So I'm just going to have a look at the comments here. Of course, everybody is saying hi as they come on. So hello, Sean and Heather and Jules and many of our Ignited and many of our Fearless members all across the country. Welcome, everybody. Yes, thanks for sharing that, Jules. If you're able to go to StreamYard.com/Facebook and give permission to StreamYard, then I can see your name. So that makes it a little easier for me to know who I am talking to. That would be great. So from Nova Scotia all the way to Alberta and BC, we have members from all across the country. So welcome, guys. Some of the questions that we're going to talk about tonight, I'm just going to kind of review some of those questions so you have an idea as to what we're going to be talking about. Here is some of the ones we're planning so far. Question number one, what is the most important thing to look for when you're starting out for long-term success? What do we look for? Do we look for the lowest price? Do we look for the best location? Do we look for the certain type of building? Do we look for the least amount of debt as possible, the most amount of equity appreciation? What really should we be looking for when we're first starting out? So that's a question. Should we be buying in an up market or a down market? What's really the best? And so we're going to address each of those points and take a few minutes to do that question. Some of the other ones, what should we be looking for when we're screening tenants? What are some top tips when it comes to screening for tenants? We're going to touch on that. How do we, if you're doing private lending, how do we lessen our risks involved in doing private lending? We're going to touch on that tonight. This question from Rendy was, how do you structure the business in the beginning? How do you pay yourself? Do you use one bank account or several bank accounts? Does each property have its own bank account? She says, or he says, I'm not sure. These are all things that keep me up at night. So these are things that come through our mind, and we need to have the answers to move forward. Another simple question, where should I purchase my first investment property? And maybe some of you have an idea. Where would you buy your first investment property? So those are some of the questions that we're going to touch on tonight, guys, and I'm looking for more from you. And also, if you have answers or opinions on some of these questions, feel free to share that with us as well. Okay, good. So here we go. Let's get started with our first question. And what is most important to look for when you're starting out for long-term success? So let's say you're an investor and you're just getting into this world of real estate investing. Maybe you've joined our group recently. Maybe you're in a few different Facebook groups. Maybe you've gone to an in-person real estate event. Whatever the case is, you're kind of interested in it. I know when we first started getting an interest in it, we were reading a few books. We read Rich Dad, Poor Dad. That's kind of what got me going into it. And we went to a real estate event that came to town. We kind of heard all about, real estate investment and how it works. It got us all excited, but then we didn't really, from that point on, have the fundamentals we needed to go forward and actually do something. And quite frankly, we weren't in the financial position to start buying more houses than the one that we already owned. So we had to figure out strategies that worked for us. So every single one of you listening tonight has been in a similar type situation. You first started learning about real estate investment. It might have piqued your interest, but what really got you going? Throw it in the chat if you have an answer to that question, guys. What got you going? What got you over that hump of having fear, analyzing properties properly, building a team that you're going to use? What got you moving? For us, it was going to real estate events. It was getting mentorship and coaching. And once we did that, we had somebody we could ask questions to, then that got us over that hump. We didn't have the fear that we had just trying to do it all by ourselves. Okay, so that's what helped us. But what do we look for? What's most important? Some people feel like lowest price. So, finding the rock bottom best deal out there. So, a house that's worth 300 grand, I got to buy it for 200 grand. And you hear about investors sometimes going out there and placing 10, 15, 20 offers and just hoping one of them sticks. That isn't a strategy I would suggest using if I were you. One of our mentors, when we first got going, always said, if you buy at market and you sell at market, because markets typically over time go up in value and mortgages get paid down, you're going to make money in real estate investment. And I would say that that is 100% true. Sometimes what people do is they wait forever to find a good deal, and they end up missing out on so many good opportunities that were out there for them. So the lowest price, no, that is not necessary when it comes to real estate investment. What about location? Let's chat about that for a second. Choosing a market, is that one of the most important things when starting out, picking a good market? Well, I'll say this. If we were to hold a property for 20 years and you had bought 20 years in Vancouver or 20 years ago in Toronto, I think you would be way better off than had you bought anywhere else in the country 20 years ago, right? Well, just based on where the real estate prices have gone since then, where the rents have gone since then. Those who bought in those markets have done extremely well. Now, 20 years ago, did the economic fundamentals say that those were the markets to be buying into? Well, not necessarily. So can we trust economic fundamentals 100%? Can we trust the fact that, we're looking for a market that people are moving into, or a market that the wages support the property prices? Now, those things are factors for sure. But if we look at the actual proof of what's happened in the last 20 years, 25 years here in Canada, even the last 10 or 15 years here in Canada, some of the markets that didn't really make sense to invest in ended up being the best markets. So should we be super market specific? Now, we have to be smart when it comes to picking a market. We have to have reasons why we're investing in that market. But it doesn't all just come down to economics, okay? So just keep that in the back of your mind. What about a building quality? Does that have anything to do with, is that a very important when we're first starting out? Should we be buying something turnkey? Or should we be buying something that's renovated already, or something that needs a renovation? Or should we be buying something that's brand new? And I think that that's kind of a personal question for each of you as to what you prefer, what would be the easiest for you. If you have the time to add in sweat equity, then that might be the best option. You can get it for a lower price. You can add in some sweat equity by doing some renovation, stuff like that. Whereas you can't really add value to a turnkey property. So, but then there's the other hand, if your schedule is busy, you work full time, you don't have the time to do a renovation, then maybe a turnkey property might be better for you. So those are kind of more personal type questions as to what's important when you're first starting out. Both of those can lead to success, in my opinion. What else is more important for long-term success? Having a JV partner, doing this on your own, or maybe doing this with partners. I would say that this is right near the top of the list of importance when it comes to real estate investment success, is learning how to raise capital. Now, whether that's through private lending whether that's through joint venturing with somebody and partnering with somebody, whether that's having somebody else qualify for your mortgages and put down the down payment and you partner with them. But the more relationships you create in this business, whether with partners or with professionals, that is probably going to be the most important thing that leads to long-term success, in my opinion. So relationships would be the answer to that question. Now, that can be partners, that can be the professionals you work with, but building strong relationships with them. What we have seen over the last 25 years of doing this is those that have a strong team, have what we call a power team. Those are the ones that successfully stay in the game long enough for equity to appreciate and for mortgages to be paid down. Okay, so relationships, building strong ones, is probably the key when it comes to long-term success. And one last thing that I'll touch on is whether you should be buying in a down market or whether you should be buying in an up market. I'm going to tell you that there's value in buying in both. Okay, now we don't want to be buying in a down market necessarily if we're just at the beginning of it going down. But if it's been going down for a while and we see reasons why it should stop or start going up, that's the time to maybe start looking at it. I think a mistake that a lot of investors make is they start looking at a super hot market that's been hot for a long period of time. And that's where they start buying because it's been hot. Well, as we all know, everything eventually tails off. And so we could end up buying near the top of that market. And it could end up taking several more years than we initially planned for us to retain or start building equity. So we have to be careful in the market that we buy on, but just be careful that we're not trying to time everything perfectly, because likely that won't happen. Okay. And we want to be looking this as at a long-term success type of thing. So it's not just get in and get out. It's get in at a relatively good time with a good investment property, one that attracts good quality tenants. That is something that will lead to long-term success. Okay, I'm going to look at the chat now. Christine says, I had clients who were doing this for a living, had no idea what that meant. Yes. Okay. All right. Your clients got you into it. Awesome, Christine. Rihanna, a reliable cash flow sheet app calculator. Yes, that is huge. Having the ability to immediately analyze very, very quickly. That's a game changer. All right, good question. Good location, tenant profile. Exactly, Nadine. Tenant profile is probably one of the number one things that people may not think about until after they've purchased a property. You can have a really, really good property that, the numbers look fantastic, but the tenant profile may not be one that you want to work with for years to come. And you may not want to be dealing with putting new tenants in every 6 months, or if it's a student rental, putting in new tenants on a regular basis, and dealing with students. Those types of things, for some people, they love it. But again, that comes down to the tenant profile that you want to deal with. Okay, so one of our Facebook users, let me just see if I can see who that is in our comments. Because for some reason, there we go. Okay, Mir says, how to find wholesale deals on realtor.ca. How do you know it's a good deal criteria-wise? Please advise. So, my suggestion for you, Mir, would be actually working with an investor-focused realtor versus you doing the research yourself. Because the beauty of working with an investment-focused realtor is they're focusing on investment properties. They deal with investors on a daily basis. They have pocket listings likely that are not on realtor.ca, that may have tenants in them already. Other investors go to those realtors to sell their properties. And that's where you come in, and it's not advertised to the general public. And why don't they advertise to the general public? Well, because they don't want the tenants necessarily knowing the property is up for sale. What happens to the tenants in that case? They get all nervous. They try to move out. all of that sort of stuff ends up happening. So if a transaction can happen without the tenants even knowing that the building changed hands, that's great for the seller. That's great for the buyer. So my suggestion would be not necessarily to look for wholesale deals on realtor.ca. My suggestion would be to look for wholesale deals with realtors that work with investors on a regular basis. And if you're trying to buy in a small town that there's no investor focused realtor in that small town, maybe that's a reason why you would not buy in that small town, because you need a solid team, boots on the ground in wherever it is you're buying. So, and good deal, how do you know it's good deal criteria? My suggestion, just as Rihanna mentioned, is throwing it into a property analyzer. And maybe Jules, you can share the link for that, our property analyzer. If you analyze several properties using that, you're going to answer all the questions you need to know whether it's a good deal or not. And if you're buying wholesale, I'm assuming the idea is you're trying to sell it retail at some point and make a profit. That's usually what happens. And so you're going to need to know the market and have your realtor back up this research by saying, okay, if we do buy this wholesale, we do this to the property, we're going to be able to sell it for X amount of dollars. So you should know your profit going in beforehand. Okay. Karina, my first property has doubled in value and it has been 21 years and location is still amazing. Yes, location is very, very important. Absolutely. And so, maybe property location or neighborhood can sometimes be a little bit more important than a market. We talk about certain markets. Let's give Edmonton as an example. Is it a good market to be buying in right now? I would say it is a good market. It's one of the most affordable ones in the country. The rents are very good, but there still are neighborhoods within that market that I would probably definitely shy away from. And there are neighborhoods that I would definitely look at buying into. So being in the right location is very important. Yes, Sean, I remember 2007. The last, we bought, 2 or 3 properties between January and July of 2007. And I would say 2 of them are probably still not worth what we paid for them in 2007. So think about that, guys. That's been what, 16 years that we've held these properties. And yes, the mortgages have been paid down and we did cash flow, but if we were to sell them today, we would sell them for less than what we bought them for in 2007. So that is talking about the way the markets can go up and down and when we buy. Yeah, Nadine, some wholesale deals are not really deals. Absolutely. Absolutely. First time tuning in. I appreciate you guys offering this wonderful resource. Absolutely. I'm not sure who that is. Oh, Kanad. I can see that's Kanad. So welcome. It's great to have new listeners here on in our group. Okay, so Jules just shared the property analyzer, guys. So for those of you that are looking to analyze properties correctly, the purpose of this worksheet, it's a fillable PDF. You have to do the calculations yourself, but the purpose of this worksheet is for you to analyze multiple properties and then compare them. It's a comparable tool. That's what it is. And so I would suggest, if you haven't used it before, download it. It's absolutely free through our website. The link here is in the chat, and start analyzing properties using this worksheet. It's what we used when we bought all 100 plus of our properties. What is considered a good cash flow on a rental property, or the lowest you would accept? Good question. That is different for everybody. Absolutely. In today's market climate, with interest rates the way they are, finding properties at cash flow might become more and more and more difficult. And so if it's difficult to find them, is that going to hold us back from buying something? Well, if our criteria is $500 a month, and it was $500 a month 2 years ago, that property likely is negative cash flow at this point. Okay, so can we say that just a straight number of $500 a month is what we need to do? Well, no, because that may not necessarily be good in high interest rate times, or if you can't raise your rents, or if vacancy is super high, all of those sorts of things. So that kind of changes, and it depends on the market. It depends on your timing. It depends on what the costs and expenses would be. What I would say is if you're getting some sort of cash flow with today's interest rates, and you're able to have that for several years to come, so lock in an interest rate for a specific period of time, even if it's a few $100s a month, you're probably going to do quite well, considering interest rates are significantly higher now historically than they've been in the last 10, 15, 20 years. So again, this is a very personal question. I would personally buy a property with today's interest rates that cash flows a few $100s a month. Would I look at it? Yes, if it was in the right location, if it was attracting the right potential tenant, high quality tenants, and was a newer property that had low repairs and maintenance, I would probably consider it. Depending on the location, depending on the property, that might change what I would need as far as cash flow. So there's a lot of factors. It's not just cash flow when it comes to answering that question. For me, I'd pick a strategy I enjoy doing. Learn how to do the numbers, then identify a market that it would work in. Absolutely. I think that that's a smart way to look at it. You know, the only thing I would say to hold you back on this is that as much as we might enjoy doing a certain strategy, is it the best financially? Maybe, maybe not. There might be other ways of doing things that maybe we don't enjoy as much that can give us a higher return or help us attract partners because we are going to get a higher return. So as much as enjoying what we do is very, very important because we don't want to do something that we don't enjoy doing. You know, we got to weigh that a little bit too. What's going to help our business flourish? That's really what we should be thinking about, in my opinion. First-time listener, another first-time listener here. Excellent. And let's see who this is. Tammy. Tammy, welcome, Tammy. I'd like to buy my first property, preferably with borrowed money, but I don't know where to even start. So Tammy, excellent. Thanks for coming. It's great to have new ones here tonight. Where to start? My suggestion, we actually have a free real estate course. Maybe Jules, you can share the link for that. Tammy, you can go on there and it will give you a good start. It gives you the education you're going to need to at least understand what the first steps are to get yourself moving, to start building a business when it comes to real estate investment. It's absolutely free. And so if Jules shares the link in here, then that's a good place to start. Really, it all comes down to education, 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 guys. The more we know, the more we speak the language of real estate investing, then the more we're going to be able to create a team around us. We're going to need lawyers. We're going to need a realtor, a property manager potentially, and there's other team members as well. And so if we speak the language and understand the concepts behind what we're trying to do, and we're educated on that, that's the place to start. Make sure that we are confident, because we don't want any of you to be going into a real estate investment just because somebody said you should, or just because everybody else is doing it. We want you to go into it eyes wide open, knowing exactly what you're getting into, because there are positives, but there are also negatives to real estate investing. So to do it right, guys, and to do it with the least amount of fear is so that you're not being kept up at night. You're not worried about your investment properties. That's what's important when it comes to that. Okay, so that's a great place to start. Jules just shared the link. So Tammy, just click on that, sign up for it, and you can go through that on an app. You can go through that on your computer, your phone, whatever it is you want to do. And that's a great place to get started. And continue coming to our Tactical Tuesdays, guys, too, because this is where we answer your questions, okay? Every single week we're here. All right, so another one of our first, Canad, real estate, Grand Prairie offers low purchase price and decent rent price. I think I'm very new to investing. How do you feel about the Grand Prairie market? I've heard a lot of people do very, very well in Grand Prairie, Canad, or maybe it's Ian. Maybe that's your last name. I'm not sure. Anyways, here's what I'm going to tell you, though, about that specific market and any market that is maybe not a major Canadian market. Okay, the farther you get away from our major markets, like our Edmontons and our Calgarys and our Vancouvers and our Torontos and Ottawas, Winnipeg, those types of market, the farther you get away from the bigger centers, the more fluctuations in market you're going to have. your rents can dramatically start to drop. They can dramatically start to go up. Certain markets can sometimes have, really high highs, but really low lows. And, over the years, we have seen a lot of success in Grand Prairie, and we've seen a lot of people that couldn't withstand the high vacancy numbers during, times when the economics were not doing well. So this is where you got to start thinking, is it worth it to go into a smaller market because we see a lot of long-term potential? Or should I be going to a larger market because I'm not going to have the huge fluctuations that I'm going to have to deal with? So that's my opinion. And I don't think there's any specific market in Alberta right now that I would tell you to stay away from. And I would definitely not tell you to stay away from Grand Prairie. Just make sure you're doing your research and you're buying a property with really good cash flow, and you're working in a higher than normal vacancy rate, not today's vacancy rate, but a higher than normal one, because that happens in these smaller markets. Okay, great questions, guys. There we go. Yeah, so excellent advice from Nadine for you, Tammy. If you're looking to do your first investment property, working with another partner who has experience, that is also a great place to start. And these types of partnerships occur all the time, guys, here within Fearless. Many of our Ignited members do business together. That's because they've created relationships. They've gone to know other investors they can trust. And, so then they can start to do some business together, buy a property together. That way you're sharing responsibility. You're sharing maybe some of the work. You're sharing the money that gets put into it. These types of partnerships really, really can add to your success and help you to multiply very fast in this world of real estate investment. So working with other investors, or at the very least, being connected and networking with other investors is very, very important. Awesome. Okay, great questions, guys. I'm loving it. I have actually only answered one of our pre-planned questions. The rest have come from you guys. So that's exactly what we want. And yes, Michael, more education. That is right. And what we have found, guys, for those of you that are listening here for the first time and really want to do this, and want to move from just learning to actually taking action, or actually creating these relationships I'm talking about with other investors that are doing it on a regular basis, that's really describes our Ignited program. So if you're really wanting some mentorship, coaching, some guidance, we get together every single week as a group. We're together in our own private Facebook group for our Ignited members. You get all their online resources. You get everything you're going to need as far as moving forward and actually doing this. For those of you that are new, maybe don't know anything about it, Jules, maybe you can share the link for booking a call and we can tell you a little bit more about it. Okay, so that has helped many of the investors that are on tonight. So Nadine, for example, and Michael, and I'm sure many of the other ones that we've seen on here have been a part of that, and it's really helped them move forward. Another question here, what is considered a low vacancy rate when looking at an area, and what would be an alarming number? So, I mean, technically, from what we've heard in the past, anything that is 3.5% or lower is virtually a 0% vacancy rate, because you're always going to have some movement between tenants. And so, a vacancy rate of 3% or lower is considered virtually zero. If you start getting to the 6%, the 7% or higher, that's when we start to pay attention that, this, and if it's been a trend for a long period of time. So, this particular property has, or this particular market has had high vacancy for a long period of time. Maybe that's because it's a smaller market. A major employer has left. I think of a small town in Alberta or BC where a lumber mill shut down. Well, what happens? Half the jobs in the town go away, and you're going to have vacancy rates of 10, 15, 20%. That becomes very, very difficult for you as an investor in those smaller markets. So, but in the larger centers, if you're I think vacancy is pretty darn low across the country right now, no matter where you are. Anything over that 5-6%, just make sure you look in to see how long has it been high vacancy. What are the factors that are contributing to that high vacancy? Make sure you know the answer to that. I'm not saying if it's high, you might be able to get a good deal. And if you market properly, you might be able to get a good tenant and do very well in those markets. But just go in eyes wide open when it comes to buying in a market with high vacancy that has been for a long period of time. Nadine, thank you. That the Fearless and Ignited groups have some of the best character real estate investor people out there. And I would agree. I think that you people that are a part of our group here are the best of the best. And we are very diligent when it comes to getting spammed in this group, when it comes to the people that are a part of it. We actually don't accept 10, 15 people a day, I would say, on an average. We're very particular as to who comes into this group. And I think that's what's made it really, really cool group of people. And that includes every single one of you that's watching right now. Okay, good questions, guys. If you have more, throw them in here. We got maybe about 20 minutes, 25 minutes at the most to go here. And I'm going to touch on a couple of the other questions that we had prepared for tonight. And one of the questions is actually fairly quick and easy to answer. And that is, a lot of times when we're first starting out, especially, and we haven't dealt with property management or tenants at any point, one of the things that might hold us back, or the fears that we might have, is, you're lacking confidence in how to screen tenants. How do I make sure that I don't get one that's going to destroy my house, or I don't get one that is not going to pay rent? And one of the things, guys, is that number one things is credit. And so we actually use single key. And I'm sure many of you on here use single key as well. And when you run the tenant application through single key, they will score that tenant for you. They will help you screen that tenant by doing that. And you'll get a good, clear picture of their credit. Have they paid their bills in the past? And to me, if somebody shows consistency on paying their bills in the past, they will pay their bills usually in the future. So the other side to the credit thing, guys, when it comes to screening tenants, is that if somebody has really, really bad credit, and maybe they're not the best tenant, and for some reason you need to evict them, whatever the case might be, you have a problem at some time in the future. What is your only ramification that they will have to deal with is that you can put a claim on their credit. And if their credit sucks and they don't care whether it gets wrecked more or not, then you're not going to get paid. If they have a good credit rating and a claim is going to go against their credit, chances are you are going to get paid. And so it increases your chance of not losing your money when it comes to that. So credit report would be the easy way for me to answer that question when it comes to screening tenants, and use the app. It's called Single Key. It's developed for us here in Canada and works really, really well. Thanks, Jules, for being on the ball with sharing all of these links. Super awesome. Thank you. Appreciate that. Okay, what other question? Eva had a really good question. How do we do private lending with less risk? So I know many of you that are on here right now have done private lending either as a lender or have used private lending as a borrower at some point. And private lending is a way that really speeds up the process in us maybe getting renovation funds, maybe purchasing a property for the short term, doing so many things that we as creative real estate investors try to do when it comes to real estate investment. Private lending has a good little spot in there. And so for those of you that don't really know what I'm talking about, it's essentially one investor or one company lending the money to you, the borrower, and you pay them an interest rate. So typically those interest rates are higher than what you would get from a bank. But it enables, usually the ability to qualify for that money is significantly easier as well. So that's kind of the point of it. And usually the terms on it are more short-term. It's a higher interest rate, but it's short-term money. enables you to do what you need to do, maybe to fix and flip a property, to do a BRRRR, to do all of those sorts of things. So Eva's question was, how do we, if you are a lender and let's say you have some funds that you want to put to work, maybe they're invested in a mutual fund or something like that right now, and you're not making very much return or an interest on your money. And you say, I want to lend it out to a real estate investor that maybe needs it for a flip or needs it for something. I'm going to lend it out for 6 months, maybe a year, maybe up to 2 years. And I'm going to get 10, 12, 15% interest. Okay. I have $100,000. I want 12% interest over the year. So I'm going to, at the end of the year, I'll have $112,000. Okay. So that's the idea behind private lending. If you want to do that, how do you do that with less risk? Well, again, we go back to number one, creating relationships. And that would be the number one thing. And number two, so making sure you know who you're investing with, who you're giving that money to, getting to know them, not just, their personality, but getting to know their financial situation. So you need to set your criteria ahead of time. Before you start these conversations with potential borrowers, you need to have your criteria. They have to have X credit score. They have to show you some potential for doing this in the past, maybe. Maybe if they're doing this for a flip, have they done flips before? Have they made money on them? Have they paid their lenders back on time? Is this the first time they're doing it? If it is, what are they backing this up with? What collateral do you have? These are types of things and questions that you as a lender will want to know the answers to before you move forward. So, and really the key to doing it with less risk and not getting your emotions involved as a lender is having that criteria established ahead of time. Before you start having these conversations, make sure that you have that baseline. And here's the baseline that somebody has to qualify at. And then you take it from there. Okay. Then you start having those conversations. So that's how I would answer that question. Okay, Nadine, the $1 million question. For conventional mortgages, not CMHC, what terms do you suggest given current interest rates? Are you personally going with shorter 1 year, 2 year terms or locking in at 5 years since it's the lowest rate? You know what, Nadine, that's a very good question. I will say personally, we are still on variable and we have not locked in. I don't know that that is the smartest solution. Would I have wished, do I currently wish that I had locked in a year ago or a year and a half ago? I would say yes. However, what we have seen, and this is kind of something that is relatively new for us as well, because, over the last 15 years, interest rates have been significantly low and variable has always worked out to be the best. But even over the last 40, 50 years, when interest rates were significantly high in the early 80s, and at other points, we weren't investors then, early 80s, I was 4 or 5 years old. Variable has, in the long term, always kind of shown to be the way to go. So yes, interest rates can rise quickly, but they can also drop relatively quick as well. We've seen evidence of that in the past. And so, for us personally, we're holding on in the variable right now. Do I suggest that for everybody? Absolutely not. I would suggest, especially for those that, and keep in mind that a lot of our properties we've owned for 10, 15 years, and the mortgage balances are significantly lower than if you had bought within the last year or two. And so, that is a factor in the decisions that I've made as well. So, in today's market, would I suggest locking in? Yes. Do I think interest rates are going to come down relatively soon? Not really. I'm not a predictor. I don't have a crystal ball, and I see a fly flying around here. I'm sure you guys have seen that as well. I would suggest that we're still a year, 2 years before them dropping below where they are now. But that's just my opinion. Okay. That's really not based on anything other than what I have heard and the research that I have done. Okay. And, that's where maybe talking to a mortgage broker, Sean, as Jules is mentioning here, is the mortgage broker that we suggest here within Fearless. So having a conversation with him, that could really help as well. Okay, another one of our Facebook users. Let's see who this is. Here we go. Okay. Liz, I suggested being a project they would enjoy in a market where it would be successful so that they get in with their heads that this is something they could really get into and be successful. From there, it's a natural progression. Yes, Liz, absolutely. Yeah, mindset is very, very important. And that's why in our Ignited program, we have Melanie, who does our momentum calls for us every single week, 2 calls, which helps change our mindset to make sure that we are not holding ourselves back and we are doing what we need to do to become successful. So that's another thing that's included in our program. Yeah, so there we go, Nadine. You're welcome. All right, guys, awesome questions that you've been putting in there. We got maybe 10 minutes left here. So if you have something to do with real estate investment, maybe it's not to do with real estate investment, throw your question in and we will definitely try our best to answer it. Or I shouldn't say we, I will try my best to answer it with the help of you guys that are listening. Next question, how do you structure the business? So this was Rendy. How do you structure the business in the beginning? How do you pay yourself? One bank account or several? Does each property have its own business number? These are all things that keep me up at night. So structuring the business in the beginning, that's a question that I would have. That's a phone call I would make with my accountant. Okay. Make sure you have an accountant that deals with real estate, investment, real estate, understands the concepts behind what we do, is able to set you up business-wise to invest in real estate. They may suggest for you to start using a business you already own or use. They may suggest for you to open a numbered company. They may suggest for you to open a business name, just a trade name. They may suggest that you just start out by doing it personally. And so that's one of those questions that is really difficult to answer because there is no one size fits all. It is different for every single investor out there. And you might want to buy some personally and some within a corporation. And it depends on whether you're going to be partnering with other people or if you're planning to just do this yourself as well. So with all of those factors included, a conversation with your accountant would probably be the number one place to start as far as structuring your business. And don't let that hold you back from doing something. If you want to start off by maybe opening a corporation, here's the other thing is you have to be able to qualify for the mortgage if you're doing this yourself. So sometimes opening a corporation, you have no financials in that corporation, you have nothing, it may be difficult to qualify for the mortgage. So having a conversation with your mortgage broker, is it better for a corporation? Is it better to do this personally? They can help you to decide on that answer as well. The question for one bank account or several, I'll tell you a story, guys, is when we were really in our early stages, I think we were at about 68 or 69 properties at the time. This was, 2008, somewhere in there. We had one bank account per property. And that was a bit of a nightmare. It was an absolute nightmare. Now, the idea behind it was rent goes in, the expenses come out, the bank account statement kind of does the accounting for us. It makes it simple for our accountant. Yes, that might be the case if you have 1 or 2 or 3 properties. But once you have 69 bank statements coming in every single month, and all of those bank statements need to be filed somewhere, and all of those bank statements need to be sent to your bookkeeper/accountant, it becomes an absolute logistic nightmare. So my suggestion is not have a bank account per property, but have a bank account per company. So if you open a corporation and it's meant for real estate investment, have a bank account for that. And if you have multiple JVs, so that corporation may be JVs with person A, JVs with person B, I may have a bank account per joint venture, just so that everything that happens in that joint venture is easy to account for. It doesn't get mixed up with what I might be doing in other ones. Although your bookkeeper/accountant can do all of that figuring out for you. So if you have a good bookkeeper, you may not even need to have multiple bank accounts per joint venture. Okay, so that's the way I would answer that question. Don't have a single one per property, especially if you're planning to have more than a few properties. So hopefully that answers that question. So someone here is saying, and who is that? Shelly, I'm having issues with my lawyer and my accountant agreeing on the best way to set up my structure. And I could see that being the case. you want to make sure that you have a lawyer and an accountant that are on the same page. You have to make sure that both of them are real estate specific. And so if they are and they're still not agreeing, that's kind of where you need to start making a decision and have, if one is saying to do it a certain way and another one is saying, well, why are they saying it? What are their ramifications? What are the real issues behind what the other person is saying? And then make a decision on, it maybe is it the legality of it that is going to put you at risk if you get sued? Is that the reason? Or is it because of tax advice and, tax wise, it's better to do a certain way. So, obviously a lawyer and an accountant are going to look at it through different lenses, through a different set of eyeglasses from their point of view. And so it's good to have differing point of views sometimes, and then you can make a decision as to really what is best for you going forward. All right. Good. Let's see. Any more questions, guys? We have just a few more minutes. I'm not going to cover any more as far as, okay, one more question that I will cover that we pre-planned, and that is where to purchase our first investment property. Now, isn't that an age-old question? We've kind of touched on that a little bit already, talking about markets and talking about, what we should be focusing on. And so ultimately, I'm just going to refer back to the answer that we talked about earlier. And that is, I'm going to buy in a location where I can get an ideal tenant profile. I'm going to buy in a location that is close to a lot of high paying jobs. I'm going to buy in a location or a province that is landlord friendly, where I can raise the rents if I want to raise the rents. Now, these are personal criteria. And it doesn't mean that if this investment property doesn't have one of these things, oh, well, then we can't, it doesn't mean we can't buy in BC or Ontario because they have rent controls. Those are great places to be investing as well. I wish I had bought more in those locations, even with their rent controls. But I'm just giving you some things to start thinking about. What were some of these boxes that, if it checks most of them off, then I'm happy with it. Obviously, something that in today's climate does cash flow, even if it's just a couple $100 a month, I'm okay with that. I like something that is more of a turnkey. That's personal. I personally hate doing renovations. I personally hate dealing with having renovations done, even if I'm not doing them myself. I tend to see that costs typically go significantly higher than what was planned. I don't like being in that situation. That's why I prefer, personally, turnkey. So you, Lee, that was your question, Lee Black. You might personally like something else. And so there's nothing wrong with that. But that's kind of the criteria that I would go off of. At what point should I hire a bookkeeper versus an Excel spreadsheet? Really good question, Shelley. Oh, no, that wasn't Shelley. I'm not sure who asked that question yet. But at what point? I would say way sooner than you are thinking. Bookkeepers do not cost a lot of money, typically speaking, especially if you're going to have them take care of multiple properties and your situation is a little bit more difficult than just maybe one investment property. Once you are past your second property, I would say that is the time to start hiring a bookkeeper. For what it costs to hire a bookkeeper, the time that it saves you, the time that you spend doing your own bookkeeping, if you're spending some time doing that, if it's something that you hate doing, pass it off right away. Because doing correct bookkeeping and having your accountant do things correctly can save you way more money. You can spend your time focused on things that actually will make you money versus the small cost that a bookkeeper costs. So usually accountants can recommend some good bookkeepers. The accountant you're using may recommend a good bookkeeper. And that would be something I would definitely look into way sooner than you might be planning on doing it. So hopefully that answers that question. All right, guys, there we go. Well, we talked for 50 minutes or so about all of these different real estate questions. And I love the fact that they were all coming in. So hopefully you found something that you didn't know before, or you got a little clarity on what you should be looking for, especially if you're first starting out. It was nice to see some of our newer members here commenting on our Tactical Tuesday. So thanks for joining us. And we, of course, do this every single Tuesday, guys. So we're here to answer your questions. And the Ask Us Anything, we're trying to do that once a month, where we do a session like this. So whatever questions or posts you put in Facebook, in our group, in Fearless, throughout the month, the good questions, the ones that we want to address, in this forum, we keep track of those. So a lot of these questions that we talked about tonight were from posts or comments in Fearless. So if you want a question to be answered at some point, throw it in there, and we will try to get to it. Once a month, we're doing our Ask Us Anything. So thanks for joining us, guys. Hopefully that was helpful. And next week, just so you know, we are planning to do Ignited success story. So we're going to be interviewing several of our Ignited members and kind of just hearing from them. These are regular investors just like you and me, guys, that might have gotten into real estate investment in the last few years. We're going to hear a little bit of their stories as to what got them into it, what got them going, what got them started, what issues have they run into, and how have they gotten over those issues? And, where are they today? Is it farther ahead than they were a few years ago? Is their life looking a little different now than it was a few years ago? Are they closer to their why now than they were a few years ago? These are some of the things that we're going to be talking to. And of course, some of our Ignited members, we're having them on because we know them. We talk with them on a weekly basis here within our Ignited group. So hopefully that next week you can join us again for a little inspiration to see that it can be done. Times now, it can be done. So we're looking forward to that next week. All right, so that's it for tonight. We will see all our Ignited members over in our laser session here in about 7 or 8 minutes. Thanks for joining us, guys, and have a great week.